Investors typically reflect environmental, social, and governance (ESG) considerations in their investment process through three broad mechanisms: investment decision-making, corporate engagement, and public policy engagement. These approaches recognize that ESG factors can influence both investment performance and broader sustainability outcomes. Rather than treating ESG solely as an ethical consideration, modern investors increasingly incorporate ESG issues as part of comprehensive risk management and value creation strategies. The CFA Sustainable Investing curriculum emphasizes that investors can integrate ESG considerations at multiple stages of the investment process, including mandate design, asset allocation, security selection, stewardship activities, and engagement with policymakers and market participants. The first and most common approach is incorporating ESG factors into investment decision-making. Investors evaluate environmental, social, and governance risks and opportunities alongside traditional financial factors when selecting securities and constructing portfolios. ESG considerations may be reflected through investment mandates, strategic asset allocation decisions, ESG ratings filters, valuation adjustments, risk assessments, and portfolio optimization techniques. Analysts may use ESG information to identify potential risks such as climate exposure, labor disputes, or governance weaknesses, as well as opportunities arising from innovation, sustainability leadership, or strong stakeholder management. This approach seeks to improve investment outcomes by incorporating additional forward-looking information into financial analysis. Within investment decision-making, ESG integration can take several forms depending on an investor's philosophy and objectives. Some investors apply ESG factors as minimum thresholds before considering investments, while others incorporate them into valuation models or use them to adjust portfolio exposures. ESG factors may also serve as indicators of management quality, operational resilience, or long-term competitive advantage. Portfolio managers can employ exclusionary screening, best-in-class selection, thematic investing, or full ESG integration approaches. Regardless of methodology, the primary objective is to enhance understanding of investment risks and opportunities while supporting long-term value creation. ESG integration, therefore, becomes a core component of portfolio construction and risk management processes. The second approach is corporate engagement, often referred to as stewardship or active ownership. Rather than simply buying or selling securities, investors engage directly with company management and boards to encourage improved ESG performance and stronger governance practices. Engagement activities may include meetings with executives, discussions regarding sustainability strategies, shareholder resolutions, proxy voting, and collaborative initiatives with other investors. Through active ownership, investors seek to influence corporate behavior, improve transparency, strengthen risk management, and promote sustainable business practices. This approach recognizes that investors can create value not only through capital allocation, but also by encouraging positive changes within the companies they own. Corporate engagement can generate benefits for both investors and investee companies. Effective engagement encourages better management of environmental risks, stronger governance frameworks, improved labor practices, and more sustainable long-term strategies. Investors often monitor engagement outcomes through measurable objectives and ongoing dialogue with management teams. Engagement is particularly important when investors believe a company has the potential to improve its ESG profile and financial performance over time. Rather than excluding companies with sustainability challenges, active ownership provides an opportunity to influence positive change while maintaining investment exposure. As ESG investing evolves, stewardship has become an increasingly important element of responsible investment practices. The third approach is public policy engagement, whereby investors interact constructively with regulators, governments, industry organizations, and policymakers on ESG-related issues. Investors may support initiatives related to climate disclosure, sustainable finance regulations, corporate governance reforms, and broader sustainability policies. Public policy engagement reflects the understanding that systemic ESG risks, such as climate change, social inequality, and market governance weaknesses, cannot be addressed solely at the individual company level. By participating in policy discussions and advocating for effective regulatory frameworks, investors contribute to stronger market transparency, improved sustainability standards, and greater financial system stability. Together, investment decision-making, corporate engagement, and policy engagement form the three primary channels through which investors reflect ESG considerations in modern investment practice.